Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. It's Friday, June 6th. And if you've been glancing at the financial news, you know things are anything but calm. We've got a stack of recent articles and analysis from major financial publications right here. And what's striking is how intertwined everything is right now. You know, politics, markets, these massive global economic currents, they're all influencing each other in really dramatic ways.
Yeah, that's absolutely the key takeaway from the material this week. It's not just isolated market movements, they're direct reactions to these high-profile political and, policy events. Our mission today is to take these headlines, the news about these, dramatic personal fallouts, ongoing trade tensions, and key market shifts and distill them. We want to pull out the crucial nuggets of knowledge so you can understand not just what happened, but why it matters and what it tells us about the current landscape.
All right, let's dive in because you really can't talk about this week without starting with what feels like a, geopolitical soap opera playing out on social media. This extraordinary public fracturing of the relationship between President Trump and Elon Musk. I mean, this went from a seeming alliance to an all-out brawl incredibly fast.
It really did, and what's fascinating looking at the reporting is how quickly this relationship evolved and then, imploded. Sources trace it back to last summer. You remember after the assassination attempt on Trump in July 2024, Musk publicly endorsed him.
That's right, expressing hopes for his rapid recovery on X, I think it was. And it seemed the closeness grew from there. They had that conversation on X later in the year, touching on various topics. Musk even flew to the idea of helping streamline government, didn't he?
Yeah.
Posting that image related to the Department of Government Efficiency, or DOGE.
He wasn't just floating it. In early October 2024, he actually appeared at a Trump rally, remember that, wearing a Mankey cap, and called Trump the only candidate who would preserve democracy. So the public alignment was very clear.
Then after the election in November, the relationship deepened significantly. Musk was appointed co-lead of this DOGE initiative with Vivek Ramaswamy. They were given a mandate to basically slash government spending and bureaucracy.
And President Trump was publicly very praising of that at the time, talking about dismantling bureaucracy and cutting wasteful spending with Musk's help. Sources highlight moments like May Musk saying they were having fun together, Trump attending a SpaceX launch.
Right.
And the president lavishing praise on Musk at the inauguration in January, calling him a new star. Musk was even brought into those high-level CEO calls with tech giants.
So it looked like a full integration into the administration's orbit,
Okay.
By February and March of this year, Musk's DOGE team was reportedly pushing these really aggressive cost-cutting measures.
Okay.
But even then, some reports hinted at potential friction or maybe Musk being stretched too thin.
Yeah.
Exactly. Some reports noted concerns about overreach. And in early March, there were mentions that Trump had told his cabinet ministers they were ultimately in charge, not Musk. Although Musk himself characterized a meeting around that time as very productive. So mixed signals maybe.
Perhaps. By April, reports suggested Musk himself was finding his DOGE involvement pretty demanding, and he pledged to reduce his time commitment.
Which brings us to last week, June 2025, and the very public unraveling. Musk gave an interview to CBS News.
Yeah, that seems to be the key moment.
And directly criticized President Trump's signature spending bill, called it massive, said it would increase the deficit, and argued it undermined the work DOGE was trying to do.
And that criticism, it seemed to be the flashpoint. Reports described this escalating rapidly into an all-out online brawl between the two on Thursday, June 5th. They were trading direct barbs very, very publicly.
The language became quite heated, didn't it? Sources report Trump threatened to pull billions in government contracts from Musk's companies. I mean, obviously a huge threat to businesses like SpaceX and Tesla.
Absolutely massive leverage.
Yeah.
Musk then fired back, suggesting Trump owed his election victory at least partly to his support. Trump reportedly called Musk crazy why. And in a moment that caught a lot of attention, Musk even suggested, though he later walked it back a bit, the idea of decommissioning SpaceX's Dragon spacecraft in response to the threats.
Wow.
Yeah, it really shows the intensity and the personal nature of the conflict.
Okay, so you have this relationship that goes from public alliance and government role to direct public confrontation and threats, all playing out very visibly. What was the market reaction? Because that link was immediate and, dramatic.
It absolutely was, especially for Tesla. On Thursday, June 5th, right as this feud was escalating online, Tesla shares tanked 14%.
14%.
In one day. That drop wiped out a staggering $152 billion in market value. For context, that was Tesla's biggest one-day percentage fall since way back in March. It pushed the stock to its lowest level since May 7th, and year-to-date, Tesla is now down over 40%.
Right.
It's a stark example of how this kind of high-profile political conflict can translate directly into shareholder value destruction.
And it wasn't confined just to Tesla stock, right? Dogecoin, the cryptocurrency often boosted by Musk's commentary, it also felt the impact.
Absolutely. Dogecoin fell about 10% on Thursday, and it's down around 22% over the past week. This timing lines up perfectly with Musk's reduced DOGE role and this public feud. Reports emphasize Dogecoin's price is highly sensitive to Musk's public standing and, the hype he generates.
Right.
What's particularly interesting here is the contrast. Crypto, including Dogecoin, had actually seen a rally after Trump's election, partly on optimism for crypto-friendly policies, which Musk and the crypto industry were pushing for. Now, as one source puts it, those who bought into that narrative are kind of paying the price as that optimism fades amidst the conflict.
So Thursday was the big market shock. What did Friday, June 6th bring? Any sign of de-escalation? Are they making up?
Well, there were reports suggesting efforts to mend fences, yeah. Tesla shares actually climbed over 4% in pre-market trading Friday morning amid speculation that a truce might be forming. Politico reported that White House staffers had actually scheduled a phone call with Musk specifically to try and mend fences and stop this from escalating further.
And Musk himself gave a hint that things might be cooling down.
He did, yeah. Hinted on social media he was ready to cool off. President Trump, when asked by Politico, seemed relatively unbothered, reportedly said, it's okay, and things were going very well, never done better. Classic Trump.
And that potential de-escalation seemed to calm the broader market jitters from Thursday as well. Things bounced back a bit.
Exactly. Stock market futures rebounded Friday morning from that sharp dip they took on Thursday, specifically because of this fallout. It really underscores how sensitive markets are to the perceived stability or, instability created by these high-profile relationships, even when they play out in tweets.
So what are the analysts and commentators making of all this? Beyond the immediate market hit, what are the bigger implications they're highlighting?
The reactions have been quite strong, as you'd expect. It's been described as jaw-dropping, a disaster for Musk. There's commentary about the Musk empire dismantling potentially happening in real time because of this.
Wow.
One significant point raised is the possibility of massive shareholder lawsuits against the board of directors in Tesla, arguing that the board failed in its duty to prevent this loss in value caused by Musk's public behavior, calling it clearly detrimental to shareholders.
So the fallout isn't just a market event. It raises these corporate governance questions as well. Serious ones.
Precisely. It links Musk's public actions directly to the company's market performance and potentially, legal liability. Analysts also note this conflict creates a fly in the ointment for the Trump administration's efforts to establish a regulatory framework specifically for autonomous driving licenses, which is obviously crucial for Tesla.
Right. And given the strong personalities involved here, some sources suggested this clash was almost bound to happen.
Yes, there's commentary that a falling out was probably inevitable given the nature of the two individuals involved. Big egos, perhaps. The discussion has ranged from hoping they make peace for the country's benefit to more extreme suggestions like seizing SpaceX through national security laws.
Preciously.
Yeah, it shows the raw political power dynamics at play and the perceived importance of Musk's assets. One specific point from a source noted that Musk's public opposition to the spending bill could actually influence its passage, with some Republicans reportedly citing his stance as a reason for concern.
That's a fascinating and, frankly, dizzying evolution of a major political and market story. But, okay, this personal drama isn't the only political factor driving global economics this week, right? Trade tensions continue to create ripple effects far beyond the U.S. Let's pivot to that.
That's right. Beyond the immediate Trump-Musk headlines, President Trump's broader trade policies are having really tangible impacts on economies and markets globally. That's highlighted in the reporting we reviewed. And one surprising example is Switzerland.
Switzerland. What's happening with the famously stable Swiss economy? Seems counterintuitive.
Well, they are facing pressure that might make them the first major economy to actually return to negative interest rates.
Negative rates again? Why?
Their currency, the Swiss franc, has surged. It's up around 11% against the U.S. dollar this year, its best performance since 2011. They're also dealing with falling prices. Consumer prices actually dropped in May.
Okay, so a strong currency hurts their exports, makes their goods more expensive abroad, and falling prices hint at deflation risk.
Exactly. And sources point out that this situation highlights how quickly central bankers might be exhausting their conventional tools when faced with the pressures of a global trade war. Traditional interest rate tools seem ineffectual in trying to counteract these trade-driven currency and price dynamics. And to add another layer, Switzerland is now under scrutiny by the U.S. Treasury for its currency practices. They were added to the monitoring list alongside countries like China, Japan, and Taiwan.
Oh, right. Being on that list while trying to manage a surging currency must be, well, challenging, given the risk of being labeled a currency manipulator by the U.S.
It is, very. One analyst quoted says the Swiss National Bank, the SNB, is essentially being bullied by the FX market into even considering negative rates again. They're in a difficult spot where they can't be too aggressive in weakening the franc without potentially incurring Trump's ire, even as they're trying to negotiate trade deals.
It's a clear line, then, from U.S. trade policy concerns influencing monetary policy options in another major economy.
Definitely. And it's not just Switzerland feeling this pressure. Sweden is another example cited in the sources.
Okay, Sweden. How is the Scandinavian country feeling the heat?
Reports indicate it's impacting their economy and household confidence pretty significantly. The Swedish central bank, the Riksbank, specifically noted last week that uncertainty around U.S. trade policy was causing substantial market movements. They've had to revise their growth forecasts downwards.
And household confidence is reportedly at a multi-year low there. That sounds serious.
It's plummeted significantly. One source notes it's currently the lowest among developed markets. It's seen as a significant shock directly linked to the uncertainty about tariffs.
Right.
This could severely impact consumer spending, which is, a crucial part of their economy.
Given Sweden's reliance on exports, especially to the U.S., this uncertainty makes a lot of sense. Things like cars, machinery.
Absolutely. Exports like autos, machinery, pharmaceuticals, paper, and steel are major components of their trade with the U.S. And some goods, like iron and steel, now face a hefty 50% tariff. The uncertainty about future tariff rates, will it be 10%, 20%, something else, is causing businesses to just hold back investments.
So they pause spending until they know the rules.
Exactly. Sources mention the EU has a deadline of July 9th to try and reach a trade deal with the U.S., which adds immediate pressure to this whole situation. It's a direct link between tariff policy uncertainty and businesses freezing investment decisions.
So trade policy creating uncertainty for businesses, forcing central banks to reconsider their tools. But there are also some unexpected corners of the market being affected, right? You mentioned automakers in the bond market.
Yeah, that's a surprising little twist the sources highlight. European car makers are actually selling the most new bonds they have in years right now.
Really? Why now?
They're seizing an opportunity created by a calmer window that opened up after President Trump scaled back some tariffs, including those on auto parts, following his Liberation Day announcements back in April.
Ah, okay. So a temporary easing of tariff fears creates a window for these companies to raise money, lock in rates.
Exactly, and there's strong investor demand for these bonds because they're offering pretty hefty yields. Deals have been oversubscribed, huge investor orders. However, it's worth noting the caution in the sources. Despite this demand and these deals getting done, some experts remain very cautious on the sector overall.
Why that?
Due to long-term structural headwinds that persist, regardless of temporary tariff pauses. Things like the shift to EVs, a competition. So it shows opportunistic financing happening in reaction to policy shifts, but the underlying challenges are still there.
It really feels like everything is becoming a strategic piece on the geopolitical chessboard these days, even something as specific as a niche petroleum gas.
You're talking about ethane, and that's a fascinating detail from the sources, yeah. The U.S. is apparently leveraging its dominance in ethane, which is a niche petroleum gas, a byproduct of the shale boom used to make plastics, as a bargaining chip against China.
How is that playing out? How do you weaponize ethane?
Well, the Commerce Department is reportedly ordering companies to apply for export licenses specifically for ethane bound for China. And they've even indicated they intend to withhold permits for specific cargoes, citing risks of diversion to the military, which is a tactic China itself has used with critical minerals, interestingly.
So ethane, a seemingly mundane commodity, is now being called a geopolitical weapon.
That's the term used, yeah. The infrastructure for this trade, the terminals, the pipelines, even the specialized ships called Very Large Ethane Carriers, or VLECs, it's all built around long-term relationships between U.S. producers and Chinese customers. It's not easily redirected. Sources mention one VLEC is just idling off the Gulf Coast right now, waiting. It really underscores the targeted disruption this specific trade tactic is causing.
Speaking of China, the sources also dive into this idea of China overcapacity or a potential new China shock. What's the dual perspective presented there? It's not all negative.
Right, there are two sides to it. On one hand, China's manufacturing is in overdrive, leading to what's termed overcapacity. This is creating anxiety globally, particularly in other Asian economies. Countries fear a flood of cheap Chinese imports will squeeze local industries. Many nations like India, Vietnam, Indonesia are already responding by putting up barriers, imposing anti-dumping duties.
Okay, so it's seen as a threat to their own manufacturing sectors. What's the silver lining aspect then?
Well, for economies that have been struggling with inflation, the influx of these low-cost Chinese goods offers lower costs for consumers. This can provide a form of relief and potentially give central banks in those countries more flexibility to consider easing monetary policy. They're trying to balance controlling inflation with supporting growth, especially with global trade tensions already slowing things down.
Right. Lower import prices help bring overall inflation down, potentially giving them room to cut rates.
Exactly. Nomura, for example, is forecasting more rate cuts in several Asian economies like India, the Philippines, Thailand, and South Korea. They see inflation undershooting targets there, suggesting these economies may be able to decouple their monetary policy path from the U.S. Federal Reserve's actions.
Interesting.
However, looking deeper, ANZ notes that the real underlying issue for China might be its sluggish domestic demand, which makes up 88% of its economy? This overcapacity domestically actually fuels a kind of deflationary spiral within China, and the report suggests China's reliance on a debt-fueled investment model is likely to continue in the coming years, 2026-30.
So it paints a picture of China facing both external pressure from trade tensions and internal pressure from weak domestic demand. And where are all these goods going, if not as much to the U.S.?
Reports show that China's exports to the ASEAN bloc, those Southeast Asian nations, rose significantly in early 2025, while shipments to the U.S. actually shrank. So the trade flows are actively reorienting, creating these shifts in regional economic conditions and trade balances. It's a dynamic picture.
That's a really comprehensive look at how political and trade factors are rippling through global markets and specific economies. Okay, beyond these major drivers, the articles also highlight some other significant market movements and themes this week. What else stood out to you?
Certainly. In the tech sector, we saw Microsoft hit a new record closing price on Thursday, June 5th, finished at $467.68. It's highlighted as the first among its mega-cap peers to reclaim its earlier highs after that period of tech volatility.
Oh, okay.
With a market cap around $3.48 trillion, it's reclaimed the title of the world's largest company. Its continued momentum seems strongly tied to excitement around AI and its partnership with OpenAI. Analysts feel pretty positive about the potential of its Copilot offerings.
And how does that contrast with, say, Apple, which has also been in the news regarding tariffs?
It's a really clear contrast, actually. Apple's stock is down about 20% this year, partly hit by those concerns over tariff threats. And it's still significantly below its all-time high from December, more than 22% down. NVIDIA is right there in the mix, too, market cap just shy of Microsoft's, around $3.42 trillion. So it shows a divergence even within the big tech space right now.
Okay. We also saw some notable stock moves after hours on Thursday, driven by specific company news, mostly earnings, right? It wasn't all macro.
Yeah, that's another layer of market drivers alongside the big macro stories.
Yeah.
Companies reporting after the bell saw significant reactions. Lululemon, the athletic apparel company, slumped about 20% after cutting its guidance for the future. DocuSign, the e-signature company, slid 16% after missing expectations for billings growth. Broadcom, the chipmaker, dipped slightly after a miss on free cash flow, despite its stock having been strong overall. And Samsara, a cloud company focused on operations, tumbled after reporting slowing revenue growth guidance. So yeah, these highlight that specific company fundamentals and outlooks are still very much moving individual stocks, even when the big headlines are elsewhere.
Right, right. Shifting gears again, precious metals have also been rallying. Gold, silver.
They have seen a surge, yeah. Silver and platinum in particular are climbing to multi-year highs today, Friday. Silver's at a 13-year high, and platinum is at its highest level since early 2022. They seem to be playing catch-up to gold's earlier gains.
It's driving that.
Well, a couple of things. Growing investor demand for metals used in key industrial applications. Silver in solar panels, platinum in automotive catalysts and laboratories. Reports suggest these markets are heading for supply deficits. Plus, the ongoing geopolitical uncertainty and this whole tariff war environment continues to boost gold's traditional appeal as a safe haven asset. So, industrial demand and safe haven buying.
Got it. And it seems the intersection of politics and markets is extending deeply into the crypto space as well, beyond just Dogecoin sensitivity to Musk. There's more Trump-related crypto news.
Absolutely. Sources report that Trump Media and Technology Group, President Trump's media company, is seeking to launch its own Bitcoin exchange-traded fund. It's called the Truth Social Bitcoin ETF BT. They've filed to list it on NYSE Arca. This is seen as, well, the latest step into the crypto world by players within Trump's orbit, coinciding with the administration showing interest in potentially deregulating the cryptocurrency industry.
Okay. Any specific details on that ETF filing that caught your eye?
The filing names Crypto.com as the potential custodian for the Bitcoin and Yorkville America Digital as the sponsor. What's interesting, and actually noted in the filing itself, is that Yorkville America, that's the parent company of the sponsor, has other existing business relationships with Trump Media. The filing points out this could give rise to conflicts of interest, which is a notable disclosure. This ETF proposal follows other moves, including President Trump's own embrace of meme coins and Trump Media's recent deal to raise over $2.3 billion, which they apparently plan to hold as a Bitcoin treasury reserve.
Wow. Okay. And for context, how's Trump Media stock doing in Bitcoin?
Well, Trump Media stock itself has been pretty volatile, down over 56% in the last 12 months. Bitcoin is currently trading around $104,400, down slightly over the past 24 hours.
Okay. Finally, just a quick mention of bonds and today's jobs report, which are also on investors' radar, obviously.
Yes, bond markets are always a key signal, aren't they? Sources cited various yields from short-term U.S. Treasuries reflecting immediate rate expectations to various high-yield corporate bond ETFs showing where investors are finding yield and taking risk. And everyone is closely watching the May jobs report coming out this morning. Strong or weak employment data could significantly influence market bets on when and how much the Federal Reserve might cut interest rates later this year, particularly given some signs that maybe the labor market could be softening a bit.
It's truly remarkable how all these different threads, a very public, personal, and political conflict, strategic trade policies impacting everything from major countries to niche commodities, individual company performance, sector trends, even new asset classes like crypto are all interconnected and influencing the market landscape right now.
They really are, and the speed and the visibility of these impacts, particularly when they play out on public platforms like social media, is a relatively new dynamic that investors and businesses really have to navigate. Understanding these specific headlines and the connections between them helps you see the complexity, anticipate potential volatility and risks.
Yeah.
Whether it's the direct impact of a feud on a stock or the indirect pressure of trade policy on a country's economy, and maybe spot opportunities like those automaker bonds or the rally in precious metals, it really provides a much richer picture of what's driving markets beyond just the traditional economic data points.
Yeah, it absolutely feels like the rulebook is constantly being rewritten by these high-profile, intertwined events. As we wrap up this deep dive, here's maybe a provocative thought for you to consider, based on everything we've just discussed from these reports. How does the increasing influence of public, personalized conflicts between powerful political and business figures, often playing out live on social media, fundamentally change the landscape of market stability and political risk that investors and businesses must navigate? It just seems like a dynamic that's less predictable, more volatile, and potentially has longer-lasting implications than traditional policy shifts alone. What do you think?
That's a critical question indeed for anyone trying to understand where things are heading in this environment. No easy answers there.
Absolutely. Well, that's a wrap on this deep dive. Thank you for joining us and breaking it all down.
Always a pleasure. Lots to unpack this week.
Indeed. And we'll see you all Monday morning with new headlines from major financial magazines.